In the current economic climate, where uncertainty looms and the future of global finance hangs in the balance, Peter Schiff, a renowned economist known for his bold predictions, delivers a stark warning. He forecasts an imminent financial storm driven by runaway inflation and a rapidly weakening US dollar, factors that could lead to a catastrophic economic downturn. As Treasury yields climb and the dollar's value teeters on the brink, Schiff points to one asset that he believes will not only weather this storm, but also surge dramatically in value. This bold prediction sends ripples through the financial world, urging investors to rethink their strategies and brace for potential upheaval. Peter Schiff has been vocal about his concerns, particularly targeting Wall Street's apparent complacency toward rapidly accelerating inflation. He boldly claims that the shock awaiting financial markets could surpass the turmoil experienced during the 2008 financial crisis, with Treasury bonds potentially mirroring the catastrophic downfall of subprime mortgages. Schiff warns that inflation is heating up much faster than expected, posing a more significant surprise than the 2008 financial crisis. This runaway inflation, he argues, will usher in an even larger financial crisis as Treasury bonds become the new subprime mortgages. Despite a reported uptick in consumer confidence, Schiff casts a skeptical eye on its sustainability. He argues that the optimism is misplaced and likely temporary, as year-ahead inflation expectations have alarmingly spiked to 5.4%, the highest since December of the previous year. Schiff suggests that if consumers fully grasped the potential for inflation to escalate well beyond 5.4%, their confidence would significantly wane. This underestimation of inflation's trajectory, he warns, could lead to severe repercussions for economic stability and consumer spending power. Adding another layer to his economic prognosis, Schiff discusses the current strength of the US dollar relative to other fiat currencies, a factor that has so far shielded American consumers from feeling the full sting of inflation. However, he predicts a grim turn of events. Once the dollar loses its relative strength, that protection will be lost, and inflation will take a much bigger bite out of consumers' purchasing power. Schiff foresees an explosive breakout in gold prices, coinciding with a breakdown in the US dollar. This dynamic, he asserts, will dismantle the current narrative of a soft landing and controlled inflation, catching most investors off guard. Schiff's analysis extends beyond immediate financial indicators to broader economic trends that suggest deeper issues at play. He highlights rising yields on Treasury bonds, driven not by economic strength but by the federal government's loss of control over the national debt and the Federal Reserve's faltering handle on inflation. This situation, according to Schiff, is creating a perilous environment similar to the one that led to the subprime mortgage crisis, suggesting a potential repeat of such catastrophic financial events. Moreover, Schiff points to the widening U.S. trade deficit as a symptom of a non-productive economy. In April, the trade deficit in goods reached $99.4 billion, marking a 7.7% increase from the previous month and setting a record as the largest monthly gap since March 2022. Schiff interprets this as a clear indicator of economic inefficiency that will likely precipitate a drop in the dollar and a corresponding rise in prices, further exacerbating inflationary pressures. As these economic pressures mount, Schiff's warnings paint a stark picture of a looming crisis that could have profound implications for investors and consumers alike. His advice is clear. The time to act is now before the predicted upheavals become a harsh reality. Investors, particularly those accustomed to the relative safety of traditional assets like Treasury bonds, are urged to reconsider their positions and prepare for a shift towards more stable investments, like gold, which Schiff posits as a safer harbor in the approaching storm. The value of the US dollar teeters on the brink of significant depreciation, and the implications for the global financial landscape are profound, particularly in the gold market. Schiff's dire warnings about the dollar's future paint a scenario where a weakened dollar could substantially enhance gold's allure as a safe haven asset. This potential shift is crucial, not just for investors, but for the general economic stability across the globe. A depreciating dollar typically makes gold cheaper for investors holding other currencies, thereby increasing demand and subsequently the price of gold. Schiff predicts that this scenario will not only propel gold prices higher, but also severely diminish the purchasing power of American consumers. This decline in purchasing power could exacerbate the economic tensions already present due to rising inflation and geopolitical uncertainties. Adding weight to Schiff's forecasts, UBS recently adjusted its gold price projections upward, citing a surge in demand from central banks and ongoing global geopolitical tensions. The investment bank now estimates that gold could reach as high as $2,700 an ounce by mid-2025. Such predictions underscore the growing recognition of gold's role as a fundamental stabilizer in the portfolios of not only individual investors, but also central banks during times of economic turmoil. Despite skepticism from some quarters, the performance of gold in recent times lends some credibility to Schiff's views. He has remarked on the metal's robust market momentum, advising investors to just sit tight and enjoy the ride, an indication of his strong confidence in gold's continuing value. This stance is particularly resonant now, with inflation rates climbing higher than many official forecasts suggest, a trend that Schiff believes is significantly underestimated by figures such as Federal Reserve Chair Jerome Powell. In the broader discussion of global financial systems, Schiff also brings Bitcoin into the conversation, expressing critical views on its impact and utility. According to him, the growing acceptance and interest in Bitcoin, highlighted by the approval of Bitcoin ETFs, could paradoxically benefit central banks and governments by diverting investor interest from gold. This diversion, Schiff argues, weakens gold's traditional role as a hedge against the fiat currency system, thereby inadvertently supporting the very systems that cryptocurrencies seek to challenge. Schiff's critique extends to the national debt crisis in the U.S., which he believes could push the country towards a scenario reminiscent of early 20th century Germany's hyperinflation. The national debt, which has more than doubled in the past decade, points to a severe systemic risk that could potentially elevate the value of both Bitcoin and gold. However, Schiff sees gold as the more reliable asset, contrasting its historical stability with what he perceives as the speculative bubble of Bitcoin's recent price movements. In one of his tweets, Schiff illustrated the significant market capitalization that gold has amassed, subtly critiquing the transient nature of Bitcoin's value surges. His analysis not only underscores gold's enduring appeal, but also highlights the potential volatility and risks associated with Bitcoin, especially in a financially unstable environment. In conclusion, Schiff's warnings are a call to action for investors and consumers alike. The potential for a financial crisis looms large, driven by runaway inflation, a weakening dollar, and systemic economic inefficiencies. As these pressures mount, the importance of re-evaluating investment strategies becomes paramount. Schiff advocates for a shift towards stable investments like gold, which he believes will serve as a safe haven in the approaching economic storm. His advice is clear: preserve your wealth, act now, and prepare for the potential upheavals that lie ahead. And remember, don't go down with the ship. Get off, preserve your wealth,